first top pick, MEG Energy, obviously classically seen as a very leveraged stock to the oil price, the heavy oil price. Remind us why it is seen as such a direct play on the heavy oil.
Absolutely. So what you're getting through MEG, and I'm one of the most bullish guys you're going to meet when it comes to the oil price. We think we're going to see all-time highs in the coming quarters. MEG is a pure play oil sand producer that has very lean cost structure and is committed to returning capital back to shareholders. They just bought 3.4 million shares of the 15 million block that I believe CNOOC was the seller. So here you've had what was the most indebted company 2 years ago now being able to actually do share buybacks. They've pledged to commit 100% of their free cash flow to returns once they achieve their final leverage metric. We have that happening mid next year. So what I like is that you have a 35-year asset. I'm only paying for 3.5 years of that cash flow. That's the trading multiple. So I'm getting over 30 years of reserves literally for free because everybody thinks we're going to be driving EVs in 2 years and oil is a sunset industry. And so with a company trading at 26% free cash flow yield, committed to returning that back to shareholders, that is the catalyst that can drive a meaningful re-rating in the share price. Given the long life nature, given the massive tax losses, which in a cash taxable sector is hugely valuable, we think a 6 multiple is a good starting point for this company. That's a $42 share price or 85% upside from here.
So there was talk this week that CNOOC, the Chinese oil giant, had sold off its shares in MEG Energy. I don't think we've had official confirmation of that yet. I may have missed it.
No, we have not. But okay. I'm using Mosaic theory when I suggested that was the likely seller. That was a big overhang. A lot of people. There was an announcement 3 weeks ago that CNOOC was likely to be selling off Canadian assets, Syncrude, MEG, etc. So it kind of lines up, and people had been anticipating this, I would say. So this is a major headwind that's been removed.
Okay. Enerplus, why do you like this one?
Enerplus trades like it's a broken company. What I like about Enerplus is you've got a management team committed to returning capital back to shareholders. They're buying back 10%. I'd like them to see that get aggressive. They have a package of conventional Canadian assets, or all of their Canadian assets, up for sale. I believe that interest level is pretty high. It should be at $119 oil. And so if they can get $400 million from that sale, they can apply that to the balance sheet. That puts them in a position to meaningfully increase the return of capital strategy. They'll be debt-free by Q2 of next year, and they're trading at a 35% free cash flow yield. So my ask of them, and I think I'm the 4th largest shareholder of the company, is I want, maybe not all of it, but I want a lot of that. And if they do that, if they pledge that, not just a 10% NCIB, they're buying back 10%, that's going to expire in August. I think they're going to renew it to another 10, that's fine. But if they're more aggressive, they're trading at 1.8 times cash flow, and they've got 14 years of stay flat inventory in the Bakken play, there's obviously a disconnect. People do not understand what fair value should be. We think the stock should trade at about a 5 multiple. That's a $40 stock. That's 158% upside from here. So you've got a management team that they're very conservative. That's not always a bad thing. You've got high quality assets with quick payouts, long inventory life, debt-free status this time next year, and they're committed to returning capital. I'd like to see them be a little more aggressive. We have ongoing conversations on that subject, but I think this name is primed for a re-rating, given that it's trading below 2 times cash flow. This used to trade at 8 times, not that long ago. And why can't the sector get back to that level, given how much free cash is being generated today and going forward, and it's all being given back to us?
Tamarack Valley.
Yeah, Tamarack's another name where you get awesome exposure to the Clearwater. We're probably the biggest investor in Clearwater through Headwater, through Baytex, through Tamarack. This is a name trading at 2.4 times cash flow, 27% free cash flow yield. They're committed to returning soon 50% of that free cash flow back to us. I believe I am the largest shareholder, so we've got a seat at the table. We've got very good dialogue with the management team and the board to try to convince them that I think 75% is a more reasonable level of free cash flow to give back to us. They want to pay down debt a little more, which is fine, but they're not far off from achieving that leverage metric, at which point we fully expect to get at least 75% of that free cash flow. So I can get access to the best play in North America, a team that's done an awesome job of aggregating a lot of drilling inventory. We think a 5 multiple on this name relative to 2.5 or 2.4 where it's trading at. We get an $11.20 potential target price. That's over 100% upside from here. So it speaks to the opportunities in Canada, in oil, and small and mid caps. Everything looks good. Services look good. Gas looks good. In my opinion, the best opportunities are in Canadian oily small caps, where I can buy decades worth, in some cases, of inventory and free cash flow for nothing. So to me, that's the opportunity. And given that people, this industry is going to be debt free by this time next year, and they're committed to maximizing free cash flow and flowing it back to investors, this is the catalyst we've been waiting on. Like, I've been working on this for 3 years. We're here. This, in my opinion, is the catalyst to lead to a re-rating in share prices trading in like the 2s when they used to trade in the 8s. Well, maybe we don't get back to 8, but if we just get back to 6, there's still good upside left.